Good day and welcome to the final video in the three-part video series of how to trade Forex from scratch. I'm Hetty now and I want to thank you for attending today's webinar. But before we start, let's look at the risk disclaimer first. Forex carries a high level of risk and it may not be suitable for all investors, so please pause your machine and read the disclaimer below. Good, let's get started. So hopefully by now you've watched videos 1 and 2 again. I keep them short and to the point, but there's a lot to cover in order to get this going. In this video I'm going to focus on increasing your bank balance by teaching you how to enter trades and how to protect your investment and how to bank your profits. We will continue with the MetaTrader 4 trading platform. As I've said at the end of the second video, in this session I will discuss the Market Watch window, Navigator, Terminal and the new order windows, and then I will show you how to add indicators to your charts, and you will also learn how to enter and exit trades. As always, we have a lot to cover, so let's jump right in. We will start today's session by looking at costs associated with Forex trading. Like with any business, there are costs involved. Although the costs are very low when trading Forex, it's important to understand what they are. Unlike stock trading, where you have to pay commissions, exchange fees, spreads and so forth, with Forex trading you only have to pay a small spread. So to understand what a spread is and how it works, let's click on Market Watch. All the currencies here in the Market Watch window are quoted in pairs. The one quote is called the bid price and the other quote is called the ask price. For the Euro-US dollar currency pair, at this very moment, the bid price is 1.3718 and the ask price for the Euro-US dollar is 1.3720. The difference between the bid and the ask price is the cost of the trade and is called the spread. The spread can be seen as the broker's commission. It's calculated in pips and it varies from currency pair to currency pair and from broker to broker. And that is one of the main reasons why we use a broker who offers a tight spread for the major and minor currency pairs. But before we go into more detail about spreads and how it can affect your trade, let's talk about the different types of orders first. The three types of orders I want you to become familiar with are entry orders, stop loss orders and take profit orders. A market order or an entry order is an order that is placed at the market and it's executed instantly at the best available price. A stop loss order on the other hand is an order that is connected to a trade for the purpose of preventing further losses. It's perhaps the most important order in Forex trading since it gives you the ability to control your risk and limit your losses. And then we have the take profit order. A take profit order is an effective way to close out a profitable trade once it reached a certain level of profit. So that is just a quick overview of the three different types of orders. Let's look at an example. That always makes it much easier. As you know by now, when a currency pair is rising, you will be buying that specific currency pair, and for a buy or a long trade, you will profit when the market is rising. To enter your buy trade, you simply need to open the new order window and click on the buy button. Remember, the green bars on the chart are the bullish candles. Green candles always open at the bottom and close at the top. When buying a currency pair, the first currency, which is the base currency in the pair, is getting stronger. The current trend on this chart is bullish, which indicates that the euro is getting stronger. It's important to know that when you enter a buy trade, your stop loss order will go below the entry order and your take profit order must go above the entry order. Take profit orders are the opposite of stop loss orders. For a buy trade, your stop loss order will go below the entry order at a pre-specified price level and your take profit order will go above the entry order. It just makes sense, doesn't it? Very logic. But if you think the currency pair you want to trade will decrease in value, you will enter a sell or a short trade. Then you simply need to open your new order window. The red candles on this chart are the bearish candles. Red candles always open at the top and close at the bottom. When selling a currency pair, the second currency in the pair, which is the counter currency, is getting stronger. On this chart, the current trend is bearish, which indicates that the US dollar, our counter currency, is now getting stronger. It's important to know that when you enter a sell trade, your stop loss order will go above the entry order, and your take profit order will go below the entry order. So this is where the trading strategy comes in. A trading strategy is very, very, very important to your success as a forex trader. A trading strategy includes specifications for trade entries, rules for trade exits, and very specific risk and money management rules. Finding or designing a trading strategy is not a simple task. The strategy that you plan to use for your future trading should have very specific entry and exit rules. Most strategies are based on technical and fundamental indicators. Technical indicators are a set of tools applied to your charts that help make the market more clear, and it can produce entry and exit signals, and many of them are specifically designed to give you an indication of the direction of the market. It's always easier if we have an example to look at. So let's add the indicator to our chart. Left click on the navigator icon up here. This is where all the indicators live. On the drop list, click on the little plus sign next to indicators, and here you can see quite a few different indicators. And if you click on custom indicators a bit further down, there are even more. There are many different indicators available to forex traders. But let's not get carried away by all these amazing indicator possibilities and stay right here with indicators and move down to the moving average indicator. Moving averages are easy, simple, and straightforward to use. Left click on the moving average indicator and drag it to the chart window, or you can simply double left click on the moving average indicator to open the moving average settings window. Here you can change any of the settings of this indicator. You can change the period of the moving average, you can change the moving average method, the color of the indicator, and so forth. But for this exercise we will leave everything as it is and use the 14 moving average. And then you can click OK. And there we are, our very first indicator on our chart. You can always come back later and change any of the settings to whatever settings your trading strategy requires. To change the settings later in any of your indicators, place your cursor on the indicator and right click. Click on the properties of the specific indicator, and then you can change any of these settings and click OK. Now this is really exciting. There are really hundreds and hundreds of indicators available to forex traders, as you've seen, and the difference between successful traders and unsuccessful traders is that successful traders use indicators that can help them determine the best trading times to get into the market and the best times to get out of the market, and there are indicators to guide them to stay out of the market altogether. Every successful trader has one or two very reliable trading strategies made up of different indicators. Once it becomes clear how useful indicators can be, there can be a tendency to use too many indicators on one chart. A question I get asked quite often is how many indicators should I use and how many is too many? The correct number of indicators will vary from trader to trader depending on what type of trader you are. There are 4 types of traders. There are long-term traders, swing traders, day traders, and then you get the scalp traders, which are sort of like day traders on steroids. Specific indicators are designed to perform specific tasks. If we look at this indicator on our chart, what does it really tell us? Moving averages are excellent trend indicators. So the basic concept when trading moving averages is when the market or the candles are above the moving average line, the market is considered bullish. And when the market or the candles are below the moving average line, the market is considered bearish. Let me walk you through an example. A buy signal can be when the market is below the red moving average line and then moves above the moving average line, and the candle closes above the red moving average line, as you can see from this example. So when the market or the candles are above the moving average line, it can be considered an uptrend. Here we have a candle that closed above the moving average line, which, according to our rules, allows us to enter a buy trade. A sell signal can be when the market is above the red moving average line and then moves below the moving average line, and a candle closes below the moving average line, as you can see from this example. When the market or the candles are below the moving average line, it can be considered a downtrend, and when the market closes below the moving average line, your stop loss will go above the entry order at a safe place, and your take profit target will go below the entry order at a predetermined price level. Here we have a candle that closed below the moving average line, and according to our trading rules, it allows us to enter a sell trade. Open the new order window and hit the sell button. To enter your stop loss order and your take profit order, left click on the terminal icon here at the top to open the terminal window. The terminal is the hub of our trading platform. Click on the trade tab on the bottom far left hand side. This is where you will manage your trades. All your trades can be viewed and edited here, including the ability to close the trade. This is the trade we've just entered. Here you can read the time you've entered the trade. Is it a buy or a sell trade? Which currency pair are you trading? And here you can see that you haven't entered a stop loss or a take profit yet. So to enter a stop loss for the trade, you first have to select the trade. Right click on the trade. The color of the trade will change to blue, and then click on modify or delete on the drop list. In this case, we don't want to delete the trade, but we're going to modify it by entering a stop loss to protect our investment. And we want to enter a take profit target. So when the market moves in the direction of our trade and it hit the take profit target, it will close the trade automatically and bank our profits. But if something unforeseen happens, or if we didn't follow the rules of our trading strategy and the market moves in the opposite direction of our trade, the trade will be closed automatically when it hits the stop loss order. Remember, the difference between the entry point of your trade and your stop loss is your risk, and this is important. So right here where it says stop loss, this is where you will manually type in the value of your preferred stop loss. For a buy trade, the stop loss order will go below the entry order, and the take profit order will go above the entry order. If you now open the terminal window again, on the far right hand side you can see the heading profit. The money value below the profit heading indicates whether the trade is positive or negative. A negative or a minus sign in front of the money value indicates a loss. Can you remember when we talked about spreads earlier in this session? When you enter a trade, the value will be negative, not because you've entered a wrong trade, but because you have to pay the spread to the broker first. Whether you enter a buy trade or a sell trade, the first few pips, which is the spread, will always go to the broker first. It doesn't matter if the trade is a winning or a losing trade, the broker will always get the spread. Now once the market hits your take profit target, it will bank your profits, but you can also decide to close your trade manually. To close a trade manually, you have to right click on the trade in the terminal window. The color of the trade will change to blue, and from the list of options, click on the close order button. Once you've clicked on the yellow bar, the trade will be closed and your profits will be in your trading account instantly. So let's wrap this video up. I've got a short action list for you to just make sure you understand everything you've learned. I want to congratulate you. You've done great. You've downloaded your trading platform and you've customized it. You understand bullish and bearish candles, and you are familiar with the terms pips, spreads, buying and selling, stop loss orders and take profit orders. And very important, you have added indicators to your chart so that you can start analyzing the market. So these are all the valuable stuff you've learned. The next important step is a trading strategy. If you want to dive deeper into forex trading by learning and following a reliable trading strategy, you are very welcome to send me an email. I want to hear about your wins and your successes. Let me know you watched this video and what you liked about it. or if you have any questions, or if you tried something and you've gotten good success, even if it's small success, I want to hear about it. And lastly, thank you so much for spending this time with me. I truly appreciate it. I hope you got an immense value from this 3-part video training, so I would love to hear from you. Come on over, say hello, and let me know about all your successes. Until we talk again, have a great day and take care.